Welcome, everybody, to our long verticals and diagonals webcast. I'm Connie Hill. Happy to be here with you today as we go into a shortened holiday week, right? Tomorrow we get the day off. Somebody mentioned here, hey, I'm excited to have a day off from the market. And sometimes that is nice to be able to have at least a little bit of a break, spend some time with family, friends, barbecue, whatever you do for fun for this 4th of July is always a good thing, right? I am joined in the chat by Barb Armstrong. Grateful Barb is here, fellow coach and good friend. She knows these strategies inside and out. And so if you have questions, go ahead, chat your question in. I want you to get your questions answered. I see one person is here for the first time to any webcast. That's Foley Games. So Foley Games, welcome to our webcasts as well as the familiar names that we see each week. Happy to see you here as well. Let's go through our disclosures. I've got a lot of ground we're going to cover here today, so let's get going on. I should say, I hope you're following both Barb and I on X. She is Barb Armstrong, CS. I'm Connie Hill, CS. We'll post educational content throughout the week, and would love to have you follow along. It's free, easy to do. Options carry a high level of risk and are not suitable for all investors. What we talk about today is intended for educational and informational purposes only. Don't consider it a recommendation. We will use technical analysis here today, but keep in mind that should not be your sole means of investment research. We'll also be using the Paper Money software application. It's for educational purposes only. I think it's a fantastic tool to practice. As you're learning strategies or trying out new rules, man, try them out on Paper Money first. Could save you a little bit of money. Or you might get all excited about it because you're making a lot in your paper money. Past performance of any security strategy does not guarantee future results or success. We'll talk a little bit about rolling strategies in our class here. Keep in mind with a rolling strategy, basically you're going to be putting multiple orders in on one ticket. So remember, you will still be charged commission and fees for each of those contracts that you roll because you're closing a trade and opening up a new one. If that becomes applicable, I'll try to remember to remind you of that. All right, let's do this. We have a follow-up on a lot of our trades, and part of our class here, following up on trades, especially these diagonal trades that go on and on for months, it's really important for us to take some time to review it so you understand the strategies. So we're going to do some follow-up on our trades, and then I have several new trades I'd like to get us into here today. So let's get on to it. So let's head over to my Paper Money account. And here we go. I am trying a new thing. I welcome your feedback here. I've heard some comments over the years of a black background versus a lighter colored background. And I have been using a black background for a while for other purposes, but I'm going to try to switch it back and use the light colored background. If you like that better, feel free to let me know because that helps me make it better for you. Okay, so feel free. Ooh, you guys are talking about some of your trades. CB wants to know about Cisco. Cisco is on our list for sure. All right. Let's come over here to the monitor tab, and we can just go down the line here. Cisco is our traditional call diagonal. And by traditional, meaning I've got one here that's not traditional. Okay, so this one simply we're buying a long option. We're selling call, in this case, calls against it with the intent to lower our cost basis. This is a June 2027 expiration option. Okay, so we've got almost a full year left in it. It cost us $20.25, and with the contracts we sell against it, we're trying to decrease our net debit and allow this longer leg to increase in value as well. So typically, we want something that's really upward trending on this. So on Cisco, it has been fairly upward trending. Is staying really nicely above this support area around 113. And so we just got in here. All right, so we sold 1 week against it. We rolled that. We've got another one right now that we need to roll. Looks like it's down here a little bit today, but it's really honoring this area of support, which we like to see support and resistance do their jobs. Just kind of don't meddle with it too much. We are in a situation here where we need to roll. It was actually, this is actually better than it was looking yesterday. I was tempted to roll it yesterday, but I didn't. I was like, oh, I've just got to make sure to be patient and wait for the class. Okay, so it's our class time. Nothing left here, hardly at all. We need to roll. Let's decide where we want to roll to. One thing that's really nice about Cisco is that we have these weekly options. And so our intent here is to close out of the trade here and roll to the one that expires in 8 days. Now, because the market is closed tomorrow, that's why these options expire today and why there's 0 days, okay? And typically what we're gonna do, we're gonna hope to roll in our class every single week. Our intent is to kind of milk this theta and decaying of the option premium, kind of try to milk that as much as we can to help lower our net debit in the cost or in the trade. So as we come out here, currently stocks, oh, look at that, right at 113. Many times people will sell out of the money. Now this is a traditional one, so I'm going to sell out of the money, all right? And depending on how far you want to go out determines, how conservative you want to be or how aggressive you want to be. And so we're going to go out of the money just a little bit here. Let's just go to the let's go to the 115s. Okay, this is a 37 delta. I also have my theta column here for those of you that are interested in what is the daily time decay element. And so let's go to 115, as I said, select on the bid price. Let's try to get the midpoint here, try to get it a little bit better. Actually, I take that back. Okay, our strike price here that we have is 120. Now with the stock sitting at 113, you might be thinking, maybe we're pretty safe, right? Maybe we are pretty safe. However, strange things have happened, right? Things can change really quickly and you can be in a position where you're sitting up on the trade, and because you get a little complacent, maybe you think, oh, I don't need to close it out. Sometimes things can happen in that period of time. Just so you know, I have been burned a time or two in the past, and then I learned, maybe we just want to close it out. Okay, so it's not going to cost us that much to close it out here. So we're going to do a roll, right mouse click, create rolling order. And remember, rolling orders just mean we're closing down one trade, bringing another one back up. We're still going to have to pay for the commissions and fees. It doesn't know where we want to roll to. It goes and picks the next contract series that comes up next, which we happen to want. But we said we were going to do the 115 strike on this. So I'm going to change that to 115. And then you can see what our credit is, which is basically the full price of the option here for the most part, because the other one is peanuts to close up. All right, there's our order. We're going to send that in. It's in our bucket here. And our intent is to trade this week after week after week after week. See how it goes, okay? You guys are taking some profits on trades. This is nice. Muriel, no, it wasn't Muriel. It's China. China likes the white background easier for what we're doing here, seeing that a little bit easier. Sharon likes the dark. George likes the dark. Dark is easier on the eyes. Prankish likes, I am old IBM, green and black screen. So you're a preference person of the darker screen. So some like light, some like dark. I'm going to try it on white for a little bit, see how it goes here. All right. Next up, let's talk about our non-traditional diagonal. That's going to be Pan W. Pan W, when I say it's non-traditional, I mean I've got a put diagonal going on here, but I'm actually bullish on the stock. Okay, let's take a look at Pan W's chart here. definitely bullish, right? The blue line's my 10-period moving average. Red is a 30-period moving average. We got in back here, and so, yeah, it's gone up fairly nicely for us. Well, we're long the put, and that long put simply is our hedge, okay? Our intent really is to be short put callers or short put sellers, right? Sell the put, sell the put, sell the put, sell the put. That is why it's non-traditional here, because we're actually bullish on it. And it's the same thing here in the sense that we want to roll frequently. Now, this one, I got a little ahead of myself and I rolled it yesterday. Okay. So I really forgot to be patient for you. Okay. And I went ahead and rolled it because it was super cheap. Let's see how cheap it really was. And let's maybe just go back to let's just go 10 days here. See what we did yesterday. So it got down to about 15 cents. All right. So it was like, oh my goodness, it is peanuts. Let's go and just roll it now. So we did. Okay. So we rolled it to a 350 put. And notice how juicy that premium is, $10.15. And the strike price, 350, compared to where the stock was yesterday, it was at that time just a little out of the money at the time that I did it. Looks like it's pulling back a little bit right now, so it's kind of pulling closer to that 350 strike price. However, we're going to let time decay work on it. And even though, let's go back to this side, even though our long put is really degraded in value, we intended for that to happen because we're just keeping it as a hedge. Our intent is not to grow its value, but to just continually sell some puts here to make up for the price of our $21 option. Okay. I already took action on it. I'll be patient this coming week. Try to wait and do it in our class. All right. We have a couple of new trades. We're just going to let work. UPS looks like it's working pretty nicely. This is a long call vertical. We did this last week. We still have a couple of weeks to still be in the trade. So we'll let it go. We've got a profit target. So if we get a certain percentage of 297, we've already got an order sitting in there to get us out of the trade. And TXN, same thing here, except it's going against us a little bit more right now than it was initially. So we're going to take a look at this. My initial thought was we're going to just let it continue to work. It cost us $5. We're down in a range where we're getting close to losing 50% of it. So let's go evaluate, see if there's been a technical breakdown here that would say, that we would want to consider getting out of the trade early. Okay, that's Texas Instruments. Let's see what's going on here. So we got in here on this day, getting in on a nice bounce off the 10-period moving average. I've written up what our trade is, 310, 320 long call vertical. It was down lower earlier in the week, but it looked like it was starting to recover now. The market looks like today might be a little bit of a sell-off day, right? Market started up higher. I'm just going to peek at my other screen. It looks like the Dow is still up positive, but the other indices, the Russell, the NASDAQ, and the S&P 500 are all down a little bit at this point. We're going to give this an opportunity to work. It's not looking as promising as it was here, but I do like the recovery that it's had. And even if we don't get up here to where our short strike is at 320, we probably can find a better exit point. Okay, so we're going to let it continue to work. The implied volatility is going up here a little bit. That maybe helps us a little bit on our long leg, but because we have that short leg, they kind of offset each other. All right. Any questions on that? See, it says, looks like there's a Harami forming. Right now on this, it might have been the previous chart. You saw a Harami there. This one looks, I wouldn't call this an engulfing candle yet. Maybe a little bit of a piercing line because it's gone well through the body of the bullish candle yesterday. So I would say on that one, maybe a piercing line, which is a potential reversal candle. All right. I would not be surprised to see it stay there today. just because of what the overall market seems to be doing a little bit. All right. Next up, another trade we did last week was Apple. I don't know how many of you did this example trade along with in your paper account, but we got in on Apple. It broke through that support, came crashing down. We got in and we put on a fairly tight stop. It stopped us out the next day, which if we're going to be wrong, I don't mind knowing soon, because typically that means we're able to minimize our losses on that trade. We can go look at numbers here. On Apple, we paid $220 for our net debit that we were in for that long vertical. We had put in 2 orders here. We put in basically if we get a majority of the max gain, we're going to get out. And then we put in a fairly tight stop here. It said, hey, if it triggers at 187, go ahead and get us out of the trade. And that's why our stop loss kicked in here. We're glad we really didn't lose that much on it, 30 cents, or in this case, $3 per contract times 9. Okay, we weren't out too bad. What would that be, like 27? So yeah, we do have the 9 contracts there, but we kept our loss fairly contained, which we like to see. Okay. Next up, what about, so Sia says, are we buying a put on PanW? No, we sold another put. That's our non-traditional diagonal. Non-traditional because it is, let's bring that back up here. Oops, get rid of the extra letters. It's non-traditional because we're long the put as our hedge leg. We're not trying to make a lot of value. We're not trying to get it to increase in value. The leg we're really working is the short leg, and we're trying to basically be put sellers and have a long hedge out there is what we're trying to do with that one. Okay, so far it's been doing pretty decent for us. We won't add up all the numbers today, but so far it's working out fairly decent. We've been in since May 29th. Okay, we did our Apple trade. I want to go back to Apple. Today they announced 5 new iPhone models that they're coming out with. So we got stopped out of the trade, as we mentioned. This was a decent support area here. Looks like it closed above it yesterday, but not necessarily on high volume. Okay, if we're looking to see if there's a resistance breakout, it's nicer if it's on higher volume. But again, the news came out today of these new iPhone models. Okay, nice up candle here today. I was looking at a little earlier when it was maybe half this height and thinking maybe we could do a long call vertical on this one. Yeah, we went bearish, we got stopped out, boom, this thing is bullish. I like the volume we're seeing so far today. Still early, so we don't know if it'll be extra volume or not, but the follow through on the candle is looking nice. Let's see what a trade setup might look like here. On this one, I was thinking to maybe do the July 31st expiration. Why July 31st? Well, that gives us about 29 days in the trade. We have, 20 to 40 days is an ideal time frame that many traders that are trading verticals like to use. It's kind of a happy medium of maybe this action can happen fairly quickly, but trying to give it enough time. We've got that hedge leg in here. With Apple, we have so much open interest, it makes it easy to do some of these weekly contracts. Okay. Looking here right now, the stock's at 307. Let's just see what 305, 315 looks like here. All right. That's 310. Let's go here to 315. All right, that would be a $10 wide spread. We'd need the stock to move above 315. Does that mean it has to move? Yeah, it definitely has to move. Where is 315? 315 is up about here. Now, do you think in a month's period of time that maybe that stock could get to that point? It could. If somebody wanted to be more conservative, you could go for the 310. right? He doesn't have to move a whole lot more to get beyond 310. So if you wanted something more conservative, you could consider doing that. You would be risking a lot more than what you have to make in that case. But on this one with the $10 wide spread, we can risk about 475. I'm going to lock that in. I'm going to take back 475. And what do we have to gain? $10. Difference in the strike prices minus the net debit means about 525 could be our theoretical max gain. So we're going to just plug it in. All right. If you did not feel comfortable going with August 31st, you can see, or July 31st rather, you can see there's some August contracts up here. Maybe you'd be more comfortable with. I'm okay with this one that's right in the middle of the sweet spot. So let's first determine how many contracts we can do. Now in our class, we're willing to risk $2,000 a trade. So let's take $2,000 and divide that by 475. Says we can do 4 contracts. Great, we will do the 4. And we're going to put in an order to say if we get a chunk of the profit, get us out early. So we're going to create our opposite order there. Where do you want our chunk to be? I ask you this frequently, and I get varying answers. Some of you are like 50%, I'm happy. If we take 50% out of there, move on to the trade, you're happy. Some of you like a range. A typical range you've said to me is about 60 to 80%. And I love that you're thinking about we're not trying to get every single penny out of it. It's really hard to do that. So if we could just get a big slice of the meat off the bone, we're going to be happy. In this case, let's go with our 525. Let's suppose if we could get 70%. If we could get 70%, that would be about 367. So let's add that to our 475. That says, hey, if we get the spread up there, if that spread is worth 8, was it 845? I clicked it too quick. 842. Then we'll be happy to get out. And we'll make that good till canceled. This is mainly trading. It looks like maybe in 5-cent increments. So let's back this off to 840. Okay. And we're going to send that in. We're going to send it to our class account. Send that on in. All right. Let's see. Apple is earning 7:30 after the market. Yeah, we turned the calendar yesterday, so we're going to start getting into earnings season next week. And Apple isn't towards the end of the month. My expectation is hopefully we'll be out by then. Let's see, you say the earnings are on the 30th, so the day before these expire on the 31st. Hopefully we'll be out. All right. Sharon likes to take profits of 50%. All right. Muriel, Corey has Apple in their long-term portfolio. All right. Ludus says, what's my take on zero DTE, zero days to options expiration? You know, we will talk about those specific types of options expirations. We haven't done it a lot in this class, simply because many people are selling credit spreads on 0 days to options expiration. And in our class, we're really not we're not doing short verticals. We're only doing long verticals and diagonals. So in this class, we haven't talked about it a lot. However, if you go to a class that I teach on Wednesdays, let's just jump over here. We do talk about those really shorter time frames, 0 days to options expiration. The playlist is index options. And so we're only looking at indexes with that particular one. And on our playlist, let's see, trading index options right here. I'm going to bring up the playlist. And then I've done a couple on 0 days to options expiration. Ben has done some on 0 days. So you can see Ben's got a 7-day one here. Here's a 0. And back a little bit, we talked about it here, shorter dated options. And then I did one that was called a day in the life of a 0 DTE option, where I tracked it all day long. Well, gee, it was a longer time ago than I recalled. Good grief. Okay, here it was. Can you see time decay happen? Okay, that's the title of it. Was done a little bit ago, but we really focused on zero DTEs in that particular session. Okay, so this class, not a lot of opportunity to talk about it, but you can learn about it there. So I hope you're a subscriber to the Trader Talks channel. Let you see our content fairly easily, like being able to just drop in on a playlist, find a topic. The other thing, and I should mention this because this actually probably would have been easier, is to do a search on zero DTE and see the different ones that have been taught on it. Oh, there's the one, a day in the life of a zero DTE. Okay. So there are several on that topic. All right, let's head back to, we did Apple. We're going long on it. What else can we see here? I have 3 additional trades here. Let's see how they look. All right. RTX. This one, had been kind of forming a new base down here around that 170-ish area. But since then, it's just started this nice pattern of higher highs and higher lows. Sometimes it's nice to be able to see that once that pattern's been established, once that trend has changed, and then wait for a brand new entry signal. So brand new entry signal could have been a bounce, or in what we're seeing today, it's looking like a decent breakout. Now, volume is not super stupendous here yet, but the day is early. But the range that it's gone across our resistance looks nice. Even if I were to say adjust it a little bit and kind of move our line up a little bit higher, make sure we're catching the top end of the shadow of that candle, right? It's in that range. It still looks fairly convincing, okay, that it's going in a bullish manner. And even though the market's selling off a little bit here today, this one's hanging in there. Well, let's go to its option chain. It too has weeklies, is traded 1.4 million shares so far today, so it does a healthy volume. On this one, I was looking at doing the August 21 options because there isn't a ton of liquidity out here in the weeklies. When that's the case, don't worry that it's to the longer end of our range, right? Typically 20 to 40 days. Sometimes we have to go to 50 days or sometimes even a little bit further to find those, find the liquidity of what we want to work with. Okay, so that's all right. We're going to do it. Stock is at 196. So what would be our at the money? It looks like probably 195 is going to be our at the money. And that's typically where we start when we're doing a long vertical. If we're trying to risk $1 to make $1 or have kind of an aggressive setup. If somebody wanted to be more conservative, you could start your spread or in the money. You could go 190, 195. And just to show you what that would look like, you could do that. Okay, you would be risking 278 to make what? 5 minus 278, okay, 280 now, which would be what? $2.20. So it'd be risky. So it'd be a higher probability. It's already above the 195 short strike. But we're going to give it a little bit of room to run here since we're going clear out to August. All right, so we're going to go 195. Let's see here, 195. Let's see if I was going to do that or spread it out a little bit. Let's look at what these numbers give us. Okay, this is not too bad. We would be risking 255 to make 245. So risking $1 and a little change to make something like a little bit less than $1. So a 90% plus percent return is what we're looking for on this. But again, we're going to put in a profit target. We're not trying to pound out every penny out of it. Okay, just is hard. When we go at the money, question from Sia says, at the money, do you prefer a certain delta or going long? Typically, rather than basing it on a delta, I'll look more at where's the at the money option. And that could be anywhere, like this delta here is 56. It could actually sometimes be a 51. It could be a 47. typically when we're looking at the money. So I would use that more of a gauge than, say, looking for a delta. Now, if somebody said, I think this thing can go a lot further than that. I think with 50 days that this stock could maybe get up here to 200, 204, then they might choose to do something even more aggressive, right? You could come out here and you could go to the 210s, super aggressive out to the 220s. We're not going to go that far. Okay. We'll just go with the $5 wide spread. Hey, how many contracts can we do? Do you guys know off the top of your head? You're getting used to doing this math. 2,000 divided by 255 says we can do 7 contracts. Great. We'll do our 7 contracts. We'll set up our profit target. So we're set up an opposite order here. And I like to set it up when we send it in. Then the decisions are made. Then you're not going back and going, oh, gee, what should I do here? It's like, no, you make the decision, you create that plan, and then you work the plan. Try to keep your hands off as much as you can. Oh, that's good news for us. Oh, I forgot to show you our Oracle trade. We'll go back to Oracle. That just got filled on us. All right. Let's go with what somebody chatted in here a bit ago about what they like. Some of you like 50%. We haven't done 50% on some of the trades here. So let's go 50%. The math calculator. If we take 245, our max theoretical gain, times 50%, that means we'd be content bringing in a $1.25 or $1.22 profit. Let's add that to 255. That gives us the 377. Now, it doesn't look like this one right now is trading. Well, some of those options are in pennies. Let's go with here. Let's go 375. We'll just pull off to the closest nickel. Okay. We'd be happy to get out of 375. That's going to be about 50%. And if that did it quickly for us, we're going to be happy campers and on our way. All right, let's hit confirm and send this to our bucket. So we've got one new long call vertical on Apple, one new long call vertical on RTX. Now, one of our trades that we did last week that was actually a little contrary to the overall market direction was Oracle. And on Oracle, we did a long put vertical. And you can see we just barely got in here as it was breaking down through support. Now, generally, we're not looking for counter trend trades, right? If the overall market is going bullish, sometimes we'll try to stick with stronger sectors and industry groups and those things that have bullish trends. But once in a while, there'll be a group that is really struggling. Right now, software is really struggling. And so we got in on the break of support here, and it just kind of continued to drift. Great. Looks like maybe in the last, it's been 4 days, it's been below our short strike price where we wanted it to go beyond at 155. However, this is what I want to show you. And let's maybe, I don't know if we have other trades in there. Oh, let's keep that. Okay, we'll have to go 8 days out here. All right, so what did we do? We bought it for 260, and we said we would be thrilled campers if we could get out at 425. And that's actually where it executed here just a minute ago. But what did we do along the way? We added some OCO orders, okay? When it got to a profitability point yesterday, we went in and said, okay, we'll keep our 425, but we want to make sure we're starting to lock in some gains. So we want to, if it starts going against us, if it starts popping up, which was a little concerning the last 2 days, let's at least lock in some profits. Let's get stopped out at $3 rather than having it wipe out all our profits after it had made a pretty decent move for us, okay? So we did an order like that yesterday, and then earlier today, the stock actually was up here, and it was creating kind of at the time, the total value wasn't in there, but it was looking like it was starting to engulf this candle with a bullish candle here. So I was going to go and get out of it. And I was like, no, let's just leave it in place. So I put it back in place. We come back here. So you can see earlier today, I just went ahead and put it right back on our $3 stop and kept our 425 limit order. And it worked to our benefit here, right? Finally dropped, went in, hit our order. So we're only in that trade for a week. Okay. Profitability on this, let's just run some numbers here real quick. See how this one did. So let's take 425 minus 260. So $1.65 gain is where we said we'd be happy campers, times 7 contracts. So about $1,155 was the gain on that spread. Now, I wouldn't say that's a huge gain. I think it's one of those where we're taking a decent sized chunk out of it. I think this one was maybe a 60 or 70% of the max gain. We're taking a chunk of it. We're not trying to milk it for everything it's worth. All right. When did I do that OCO? Was it in another class? No, I actually was not in another class because I try to review the trades for our class only in our class, unless for another reason to teach something else. So the first time, let's see. The first time I did it was yesterday. Okay, so it had just been sitting in here at that 425 credit, and 625. Yeah, that's just when we got in. So yeah, I think I just put it on yesterday. And that's when I saw, okay, we paid 260 for it. Let's at least get something out of it if it reverses on it. If we have, a real bounce in the market, let's take some profits out. And this was just arbitrary, $3. In terms of when I put it on, I think it was sitting at 360. Okay, so our spread was worth 360, and I was like, okay, let's give it some leeway, but let's put on that stop order. That makes sense? All right. For the Apple trade, ER 730 earnings report. All right. Very good. Sia says, what if it goes opposite side? Was that on our new trade? Was that on our RTX? Each of these trades, we'll continue to monitor them each day. And if we get in a position where we're maybe close to having a profit, or hitting the profit we had in there, we might go ahead and say, oh, let's go ahead and just get out early, take the profits and go. Or if we have a technical reversal, what would mean a technical reversal in this trade? I would say if this thing comes and closes down below this support area, make sure you give it area. It's not just exactly that little line. If it has a significant close below that area, then it would be, this thing, that was a fake out instead of a breakout, and we'd want to get out of the trade fairly quickly, kind of like what happened on our Apple trade. We could, if we wanted, put a stop loss in at the same time and do an OCO order. In our class, typically, I will just say, put on the profit target and maybe add on the stop piece later, either to lock in some profits like we did on Oracle, or if it's getting close and we just need to get that in there, maybe we can't babysit it the next day or whatever, and we just want that order to sit in there. So Sia says if it goes bearish, exit at $2. Well, we could decide here. We got filled here at 250. We thought it was going to be 255, but we actually got filled at 250. So if you wanted to go 50 cents lower, you could. That might be a little tight. Tight meaning option prices are, when they move a lot, right? Versus a stock, stock moves 2%, but the option moves a lot more than 2%. So wherever your comfort level is of doing that, absolutely, you could do that. Some people might start it at maybe half of what it cost us to get in. So some might start at 125 and then inch it up if the trade progresses. or whatever you're finding works for you, right? If you wanted to start out at whatever that is, 50 cents lower or whatever. CB says, if I make changes outside of classes, there's somewhere we can follow on your updates. Not necessarily. I can't really post about them in my X account. I've gotten in trouble for doing that before because the whole context and the whole understanding isn't in the whole post that I might make, right? There's not a lot of room to do that. So I try to bring you up to date on it when we have our class. And if I like on the diagonals, I'll try to wait till we actually are in class to do them. But I will say, yeah, if we've got a significant profits, I'm going to add that additional stop. Okay. So great. Appreciate the conversation here and the questions. Can I review the criteria when you added an OCO? You bet. So let's go back here to Oracle. And let's go back to the chart. So on Oracle, it had moved kind of decent for us. It's kind of like drifting down. It wasn't like it had a huge bounce down. If it had a huge bounce down, then I may have considered doing it sooner. But it was just kind of drifting, right? Just kind of gradually moving. And so it was when I saw, hey, we could get out at 380. Our target orders for 425, but we could get out at 380, which would put it about 50%, which some people are happy with 50%. So I did not have a hard and fast criteria other than we have a significant profit beyond 50% or 50% or higher. So if you wanted to use that, something like that as a criteria, you could. That's not necessarily the only one. But if we see it make a big move and we're like, oh, we have some decent profits in that, yeah, that's when I would consider putting it on. If it's still just kind of diddle-daddling along and not moving a whole lot, like it didn't move a ton here. It wasn't really till yesterday when it was like, okay, that makes up a significant move. All right, hopefully that will help. Sam says, Brent pointed out yesterday, you can exercise the long call in this case on RTX at 195. Let's talk about that. We can kind of end on this thought here, Sam. When we're in, let's go to our RTX. Let's just get over here. On our RTX, we're long, say this 195, and we can exercise it anytime we feel like it. Okay, we certainly can. However, that's not the intent of this trade, and that's not why we're doing it. So in our case, we're probably not going to exercise, but we certainly have that right. From the moment we get in, we have that right. Okay, and we have a potential obligation here, right, with our short leg here, that, okay, we are willing to deliver the stock at $200 to somebody else if we get assigned. Okay, now right now, stock is well above $200, so financially it doesn't really make sense for somebody to do that, but they could, right? They could. Now, let's see. So we fly by the seat of your pants as in plugging. I don't know that we fly by the seat of our pants, but our intent is not to do that. Our intent is to let the vertical play out. So we're going to. That's our intent there. If we get a significant gain that is short of what we have in our working order, we said 375. Say we get up there to 360 and it's coming to the close of the day and I'm not going to be able to watch the market the next day. Yeah, I might consider getting out. Or I might just say I've got it in place. I'm not gonna fiddle with it. We'll just let it execute. Okay, so it just really is going to depend on the kind of rules you feel comfortable with and what kind of time you have available to pay attention to the trades. Because sometimes you just want to set it and forget it and be done, right? So however it works best for you. All right, so in summary, we made profits on Oracle. It came down, hit our target. We hit our stop loss on Apple, but put on a bullish trade on Apple. On Cisco, we rolled. We sold a contract out. On our PanW, we sold again, except I did it early yesterday. I'll wait on next week. And then RTX and Texan, I might have to visit that a little bit early if it has a significant technical breakdown. And UPS, we're just going to let those trades just continue to work. All right. You guys have been great. I appreciate you being here today. Barb, thank you for helping out in the chat. I appreciate your comments, your questions. I hope that you're feeling really comfortable, getting comfortable with how both these strategies work, diagonals and long verticals. Now, somebody said here, maybe talk about the market forecast study as a recommendation. Sam, I have been doing that in our index options. I think you might be in that class. I think it's fairly applicable in that scenario, but you could use it anywhere if you wanted to, you bet. All right, you guys, coming up next, we have, who do we have coming up next here? We have investing in dividend stocks up next. So this is investing in dividend stocks is more investor related, right? And so that'll be right at the top of the hour. Thanks, everybody. We'll check up on all these trades again next week. We'll see you then. Bye-bye.